Hi guys, welcome to M Talks. Good evening, Nikhil. How are you?
Good, bro. How are you? How's
Doing-
everything?
Doing good. Everything is doing great.
Yeah, bro. I felt like our last conversation was not complete, so I think we should continue
it's
that conversation.
definitely 20 minutes is not enough to talk about tax. Tax is a huge thing.
Yeah, but other than that, Thanksgiving feeling fat and heavy. Ate a lot of good food.
I know.
Spent some time with family. It was a good time. Other than that, regular week trips happening this week actually.
That's good. Out of state, right? Or out of country?
Well, theoretically out of country. But
Out of country? Good. Enjoy, man.
thanks, bro. But yeah, so like last time we talked about tax now, right? There's three different baskets when it comes to taxes, right? And tax planning, tax now, tax later, tax never, right?
Right.
And we talked about tax now. I think most people kind of know about tax now, but most people should talk to a financial planner too to plan better for their tax now situation.
I was discussing about the same topic with someone today. It was a group session. So I was talking about the tax now, right? So there was some listed items were there. I think it should be good to discuss here too.
Yeah, let's discuss it.
Let's sit out.
Yeah.
So what all the things we pay tax?
Income, like W2 income,
W2 income, and
1099 income,
anything you purchase, consumer products.
consumer products.
And New Jersey have some tax.
New Jersey doesn't have for clothing and for
medicine,
medicines, water, and grocery food. Cooked food, you have to pay tax. But if you're buying like from a supermarket, like raw material food, you don't pay tax.
It's like a ShopRite.
Yeah,
shopping, right?
Any grocery
Right,
store
kind of.
shopping. Yeah.
Yeah. So other than that, any consumer products we purchase taxable.
Yeah.
What else we pay tax? Lottery winnings.
I mean, yeah. I think that's everybody. That's
Right. And
Yeah.
gifts. If you receive gift, there's a gift tax.
yeah. That's a complicated thing. I think if you get more than 15,000 as a gift,
Correct.
So don't say you're giving gifts to anybody.
It's taxable. And what else? Property, definitely property tax.
Taxes, obviously, especially in the East Coast.
Property taxes, it's huge here. And what else? So all the major things, everything is taxable. And inheritance properties.
Inheritance tax.
Inheritance tax is a
Yeah.
huge thing too. So
especially if it's a direct inheritance, which we can discuss.
It's another topic,
It's another
definitely.
topic. We need to discuss about that, about trusts and wills and stuff like that. But
right.
yeah. So like that's tax now. We know everybody's gonna. You can't escape doing any of those taxes, but you can plan with regards to your taxable income. You can reduce your certain in your tax return in your 1040. You're not taxed based on what you're getting as your whole like W2, like your gross tax. You're being taxed after everything that they've taken out. So like this, it's basically, let's say you get paid $100,000 a year gross, but you paying in your hands. You've only gotten, let's say, like 100 and like basically social like the social security that's taken out, Medicare is taken out. So all of that is reduced in your tax when they calculate your taxable income. So your earned income is one number. Your taxable income is another number.
Another number if you're a business owner, right?
If you're a self-employed, I mean, if you're a W2 as well.
W2 as well.
Yeah, because you're contributing to your 401k and stuff like that.
Exactly.
Yeah. So, but the thing is, you have to do that. Some people don't take advantage of their company's matching, which people free money. You have to do that. That also helps you reduce your taxable income. Any money you put into your 401k, max of, I think it's
What number?
for 401k,
22,500.
22,500 this year. Up to 22,500 you can contribute. And if you contribute up to 22,500, that 22,500 is reducing your taxable income.
Exactly.
You're paying taxes on that money later, right? So that's the tax That's the tax deferred, tax later basket
The second
products.
second basket as a tax deferred we can reduce the tax now, but eventually down the line,
You're reducing
definitely.
taxes now, but those are tax deferred products. So
Exactly.
you're reducing a tax, you're reducing, but that's something that you should be doing. People should be doing that.
Everybody should be doing like, especially if the employer is matching, don't waste money.
Don't waste money. Yeah, you're getting free 5%, up to 5% of your
5, 6. Before it
6%.
was like up to 10, but now it's like everybody down to
reduced,
3,
yeah.
2, and all.
I think now it's like 3 for most people.
Yeah,
Unless
the
you're at a good
majority I
company,
would
it's
say like a 3%.
3%.
But there are still companies paying more than 6% too.
Right.
So it's purely depends on double check with your employer or the HR to make sure that if there's any chance of getting free matching from your employer, go ahead. Don't waste.
And in that same conversation about reducing your taxable income now, what most people don't know about is short-term real estate holdings. If you have short-term real estate holdings, so basically what that means is, let's say you buy an investment property and you're using it as like an Airbnb or like a vacation rental thing. So short periods. In New Jersey, a lot of people do that, either like by the lakes or down the shore. What people do is they buy an investment property for themselves. Well, what they do is they buy it for themselves, and then they block out times in the summer where they market it out. So then what they are able to do is basically write off any expenses on that property as short, because
And during that period, right?
during that, not only that period, any
Anytime.
short-term rental property accounting, you can literally reduce your personal income tax with the losses of that.
Correct.
So it's all paper losses, right? It's paper, like, so let's say you bought a short-term rental property in the shore, right? On the shore, you got like an apartment for like $200,000. Now that $200,000, if you're using as a short-term rental property, you can basically like depreciate the entire amount. I mean, there's a little bit more complex like accounting that goes into here. That's where you need to talk to a tax expert or like a tax accountant or like a CPA or someone, or a financial planner, or a tax attorney. But they'll tell you, like, just I'm giving like the big level picture. If you have short-term income, like short-term like investment properties that you like for holidays or whatever, that you basically market for the summer. So like on the beach, for example, people rent their houses, they get like $30,000, $40,000, $50,000 in the span of 3-4 months.
Correct.
Down the shore. That's $60,000 is income.
And you can claim it as a loss or expense.
If any expenses on that house though, you can write off on your personal income.
Personal income.
So whatever, let's say you made $60,000 in 4 months. Let's say you had $60,000 worth of expenses. You had, let's say, $80,000 that year, right? Because you improved some on how you might have renovated the entire apartment, whatever it might be. So, but you only made $60,000. So you can completely write off $60,000 off the $80,000 of your expense on that. The back $20,000 that is there, you can reduce it, from my understanding, of your personal income.
Got you.
So if you're making $100,000 on your W-2, you can easily bring it down to $80,000 because of this $20,000 loss.
The property we're using as a short-term income.
Because you're using that property as a short-term investment property.
Yeah. Gotcha.
So that's one thing that I come like, that's something that people, I think some people know about it. Not everybody knows about it.
The people who know basically trying to do it.
Oh, they do it for sure.
Right?
Especially here because there's a lot of Airbnbs, a lot of...
Gotcha. Recently, one of my cousin was actually inquiring about Airbnb investment, and I was guiding to, Nikhil. So, yeah, that's another investment portfolio people think about.
Then you should think about it because it's actually helping you reduce your taxes now.
So, end of the day, what we're talking about the tax, how many ways we can reduce, right?
Yes.
So if you're a business owner, 100%, there's potentially a lot of opportunity to reduce the tax.
Yeah, marketing expenses, your commuting expenses, if you're
home office, furnishing.
square footage. But mind you, that's one of the biggest, from my understanding, biggest things that the IRS tries to catch people.
Exactly.
They actually make sure that your own home office is actually the right square footage that you're claiming.
Correct.
So if you're claiming home office, and let's say you have a 150 square feet room that is your office, Don't put 450 square feet when you're filing your taxes, because they will come for you.
Exactly. So everything has to be proper. Legally, you can get a lot of benefits. Unfortunately, because of the lack of knowledge on this topic
Or planning, yeah.
or planning, or we're not getting into a professional, so we're missing it out.
Yeah.
So don't mislead yourself by listening to this. There's a lot of ways you can reduce taxes. We're talking about only on legal ways.
Yeah.
So if you're doing something, you wanted to reduce tax, go with the legal advice or how things getting done and use those advantages.
Yeah, and like if you need resources, reach out to either Bibin or I, and we can connect you guys to our guys that we use.
Absolutely.
But that's one thing that I thought we missed in the last episode. This taxes is a huge conversation. So it's like
tax is a never-ending conversation. A lot of things to mention.
So let's talk about tax deferred now, right? I know 401k comes in part of that. What else comes in part of tax deferred baskets?
So basically annuities basically comes under tax deferred. We don't pay tax right now, but the growth is taxable. And I mean, how we can put annuities? Annuities are like a different types of annuities.
Okay.
Right? A lot of companies doing annuities. So how the annuities work with the three major strategies: fixed annuities, variable annuities, and index annuities. All three is available out there for public.
Mm-hmm.
So how we can utilize annuities is actually it's another retirement fund.
Mm.
So you don't need, if you're putting money from your pocket, you already pay tax for it. The growth is taxable when you take the money out. If you're putting money in annuities, it's already in the tax deferred bucket, and which will apply all the retirement regulations to that money.
Mm-hmm.
Even though you have a 300,000 or 100,000 in the bank, you wanted to grow money in a safe place. Maybe index annuity will be the one of the safest place to grow money right now.
Mm-hmm.
So if you are deciding to put the money in there, remember that money fall into a retirement account. Anything related with the retirement account laws or regulations, it's gonna fall into that money moving forward. But it's a really good product to explore.
So let me ask you, those products, like that product, does that work as a 401k where you're putting in pre-tax dollars or you're putting in post-tax dollars?
Basically, it depends on how you're gonna put. You can put both.
Oh, so you can basically set up an annuities.
No, not like that. If you have a fund in pre-tax bucket, that simply means just remember you have a 401k and you move the job. You have an old 401k sitting in with your previous employer fund.
Got it. Yeah.
So there's two way people does it. Either you move to the new employer, which is actually not an advisable way, but that's what majority of us know.
Yeah.
So that's what we do. We always go with what surrounding does, right? So that's what we've been seeing. We do that. But there's a crazy different opportunity out there for you to protect that money and it's the same thing get the
grow
growth.
it. Okay.
So that on that sense, maybe you can utilize the index annuity.
Okay. So so these are already basically the annuity accounts. You can't if you don't want to do if you want to take advantage of the pre-tax, then it has to go into a 401k first.
Exactly. It
and
has
then
to be
so you go put it into 401k and then you roll it over when you
break the contract between you and your employer. It's like a 3 different category you can break that. Either you move the job, or you are 59 and a half year old, or you retired.
So let me ask you this. Let's say one of our listeners has been working in the company for 30 years, right?
Mm-hmm.
They've been putting all this 401k money in there. Obviously, right now, 401k is starting to dip right now. I think everybody's going to start seeing a little bit of
everybody's worried about 401k now. Yeah, correct.
So let's say they're 30 years in and they have this money in their 401k and then they retire. And now the money starts going down because they're living off the money and the market's down.
Correct.
In those situations, you're saying transfer everything into a fixed income?
There is a lot of different variety of way you can manage that money.
Okay.
Right? So what we usually does, or what generally people, or traditionally what people doing as a retirement planning, what we do, the 401k is a variable market.
Mm-hmm.
When the market goes up, your money grows. When the market crashes, your money lose. Right? But there's nothing wrong with it. That's how it works. But it's up and down.
Yeah.
Whoever invests in, they need to understand how that works. That's what matters, right? So usually when I'm getting close to 60 or 65, what will be my priority? Do you think I will be still playing around in the market?
Definitely not.
Definitely not.
Yeah.
So what comes to the picture? The priority comes as a security. You need to secure your money.
Right.
Whatever you have so far accumulated, you need to protect it. So what is my best option so far available out in the market is?
Annuities.
No, what we do right now, right? What we do right now, we just secure the money within that account itself. So what is the best option there? Maybe you can put in the money market. The money is secured. You're not going to lose money. Or you can put in the G fund or government bonds. That's one other area. You can secure the money. So what do you get? The security.
Right.
But what do you sacrifice?
The growth.
Is the growth. So take a quick math. You have $1 million, right? And that's your accumulation for the retirement. And you retired. How long you going to live after retirement? We don't know. Absolutely, we don't know. It's not in our hands. Just think about, we need $100,000 a year for you and your wife to live a decent living as a middle class family
In the East Coast.
in the East Coast.
Yeah.
Right. So if you need $100,000 and you securing your money like a traditional way, how long that $1 million will help you? You get security. Your money is there.
10 years.
Million is there, but no growth. 10 years, you basically stack up $1 million and taking every year 100,000.
Right.
10 years will be over.
Right.
In case if you need 150,000, about 6+ years. That's it. Even you have $1 million, this is all we can utilize. But if you do it properly, you can get the 100% security on that money, and also you will get the market growth. That is one of the safest area we would recommend with the annuities.
So these are people who are retiring, right?
People who are retiring,
retiring.
or they're moving the job.
Okay. So how about this? My question is this though. You can have your company sponsored 401k, right?
Correct.
Can you have a separate 401k?
Separate 401k or similar to 401k?
No, separate like a 401k where it's pre-tax dollars going in. No, right?
401k is not possible, but there are similar products out there. Pre-tax, you can move money.
So you can't have two 401ks.
No.
Okay.
But take an example.
Mm-hmm.
You are a self-employed. You're going to have a 401k.
Right.
Do you?
Yeah.
No, if you are a self-employed, you're the business owner.
Yeah, if because I can write off about $50,000 based on my income.
As an IRA.
It's basically a 401k and an IRA.
Similar to 401k and IRA.
Yeah.
And also you can put something as a SEP IRA.
That's the IRA.
That's IRA,
Yeah.
right? That is actually you can move pre-tax money.
Right. That's for business owners. That's for self-employed, right?
Self-employed,
But
right?
for employees.
No, actually, there's a limit. 401k, you can put only up to 22,500.
Right. You're making $100,000 a year.
Correct.
Okay. Your company is giving a 5% match.
Absolutely.
So up to $5,000 you put in for the year, they'll give you another $5,000. Right? Simple maths. So I've heard, okay, so that one 401k, you just put that 401k, the way the company sponsored 401k,
you're getting 10,000 you're putting together.
Yeah. So, but you put that, you have to put that 5k, right? Because otherwise you won't get the 5k from the company.
Correct.
That's free money, right?
Correct.
And that's going to grow. Now, out of the 22,500, you have 17,500 left.
Correct.
So that 17,500, can I start another 401k with it?
So what's the difference between you participating with your employer 401k and you starting another 401k?
This is what I'm trying to say.
Mm-hmm.
I do that, and it's pre-tax dollars, right?
Correct.
I'm putting into that account. So let's say I keep putting that money into that account as a young guy, someone who's just getting in,
Mm-hmm.
and I'm able to do that. Am I not able to transfer that into an annuities in let's say 10 years time? Or, you know what I mean? Isn't there a benefit that way? Because it's pre-tax dollars going into an annuities account, so your money doesn't go down and it's growing.
In annuities, correct.
But you can't transfer it over while you're working, you're saying?
Correct. Once you are under contract, you won't be able to.
Got it. Okay.
Right? You have to break the contract. What is the way of breaking contract? That's the same thing we explained earlier. You have to move the job. if you're working as a per diem, you work like a once a while, maybe once in 3 months,
Mm-hmm.
and if you're putting a 1 hour in that job, you still won't be able to move it.
Got it.
Another area, even you're retiring, the actual guideline is actually you won't be able to touch your 401k money until you are 15 and a half year old, right?
Right.
But the current employer, you working for an employer last 10 years and you're retiring and you're only 55, you can access that 401k money at age 55 without penalty
Got it. Okay.
with a current employer only. Before that 10 year, you worked another 20 years with another employer. That money is in somewhere else. You're growing. That money fall into the old rule, 59 and a half. With the last employer you worked and you're retiring at 55, you will be able to touch the money without giving the 10% penalty.
So if that person, so let's say if it's been one company for 30 years or
Yeah, 30 years. And you're retiring at
at
55,
you can start withdrawing money.
You can start withdrawing money without penalty.
Okay. Got it.
So that is an out.
But you
another
pay,
option.
but you're paying taxes on the withdrawal.
I mean, taxes, definitely there.
You're paying all
You cannot avoid tax 100%.
Right. So my other question then is that's tax deferred, right? Part of the tax deferred conversation.
Correct.
Okay. How about IRAs and Roth IRAs and backdoor IRAs?
Right. So there's like a multiple ways. I think Roth IRA comes into the third bucket. We'll talk in a different way. I don't think its time is enough for today. But in the third bucket, it comes as a Roth IRA.
Okay.
Right. And backdoor Roth also, there's a potential possibilities. And people doing it. But when I heard that first time, right, I thought it's something illegal. It's not illegal.
It's not
a
illegal.
legal thing.
Yeah, it's a legal thing.
It says like a backdoor Roth IRA because there's a lot of limitation for investing money in Roth IRA.
Right.
So if you are making a good decent money, maybe you're not eligible.
Got it.
So if you have very less money, you're making very less money, you cannot afford it. That's how it's designed by design. So 401k is okay. They will give you 22,500 limit. You can put there. Money will be growing, tax deferred. The reason is because government need tax.
Right.
End of the day, you can put like that.
Oh, so this is benefiting people. It's
This
not
is-
benefiting the company, the government.
Exactly. This is
Got it.
benefiting people. That's why they have a lot of restriction on that. So if you have a lot of restriction, that simply means it might be beneficial for you.
Got it.
So you can conclude like that. 401k has less restrictions, and Roth IRA, when you compare with the 401k, Roth IRA have a lot of restrictions. That simply means Roth IRA might be good for you. I don't know.
Yeah.
I don't know. It purely depends on individual though.
Everybody, I mean, what we are talking about, I think we're going to talk about this on, like for another episode as well. But please, like, don't listen to just us. Definitely consult a tax attorney or a CPA. They'll give you the right strategies. But please talk to one.
Put some comments.
Yeah, and put some comments and get a financial planner if you can. Doesn't matter how much money you make. If you start planning for your finances, earlier you start planning for your finances, the earlier you are able to retire.
Lot of laws related with money in this country, and lot of ways of for benefits too. So if you get through it, you can decide which one will be better for you.
Right.
Maybe something is better for me, maybe not good for you, Nikhil.
Yeah.
So you have to find out which one works for you.
Right.
To find out the best way, consulting a professional will be the key.
Right.
So any questions, any concerns, you can always put in chat, get touch with us. We'll be open to.
Right.
So we do this kind of help to people. So we do provide services.
Bibin's an expert, so he'll definitely help you guys out.
We can touch with it.
Yeah. Hope that was helpful, and we'll catch you the next time.
All right. See
Thanks,
ya.
Bibin.